2020 was one of the most difficult years to predict what was happening within the mining space. That's according to investment bank SP Angel. Well, joining us now from there is John Meyer, who's a mining analyst as well. John, good to talk to you. Interesting quote, actually. I mean, last year was very difficult from a number of different angles. But are we getting any more clarity this year? And what was it last year, particularly, that you found so difficult to get a hold of in order to give a steer on pricing?
Well, we started off the year with stories of the coronavirus coming out of, well, about mid-January. I think the genesis of that virus is now relatively well known and well covered by certain television groups. Of course, we then went straight into, well, not straight, but fairly quickly into a major lockdown as the pandemic went around the world. We had to figure out what that was going to do to industry. A lot of closures. There was a certain amount of disruption to supply, and it turns out that the supply disruption pretty much equaled the loss in demand from factory slowdowns and closures. So the market was relatively well balanced. In fact, in some cases, we went into deficit situations with certain metals, which has caused prices to rise, and probably caused metals prices to rise a little bit faster than many other people had expected. We thought we were going to come out of these series of lockdowns. In fact, we went into a second lockdown in the autumn, and now we're in a third lockdown, and things are still quite bad. Even though China has largely controlled the virus and managed its situation very well. In fact, it's recovered much faster than most of the rest of the world. We are hearing anecdotal stories of factory closures in parts of China and people struggling to get the bits that they want. We also know that there's a problem with chips coming out of Taiwan. That's not so much to do with the coronavirus. That's more to do with automotive companies, I think, cancelling or postponing orders for computer chips, and then realizing that actually markets are recovering much faster than they had imagined. So in some respects, whilst not being able to get hold of those chips is bad news, the fact that the demand has recovered much faster is actually very good news from a consumer's perspective, and also from an economic perspective and from a metals demand perspective.
Interesting, isn't it, looking at the supply-demand balance you're talking about there going to deficit. And part of the reason I know during last year was the fact that mines had to close. So there was just not the supply coming through. But I think you and I have spoken about this before, and especially in areas like copper, where the anticipation is we just don't have enough copper coming through the pipe in order to supply the demand that I know that you and your colleagues are expecting within the mining space. What is the solution to this? I mean, do you just expect higher prices and have done with it? Or are you trying to encourage miners to continue to look for and invest in the opportunities that you still believe that are under the ground that haven't yet been discovered?
Well, so the analysis of last year is that the build-up in metals inventories just didn't happen. And looking forwards, it's really hard to see where the metal's going to come from to meet the new demand, because remember, we've got this enormous electric vehicle industry that's gearing up. 176 new mega factories and gigafactories, all ramping up production around the world, all needing to draw in lithium carbonate, spherical graphite, manganese, cobalt, nickel sulfate, all these different products, all very much in demand, and where the mining industry doesn't have a lot of room for expansion. In fact, high prices are not necessarily enough on their own to help the industry bring in new production. We just can't see where it's going to come from in many cases. So, if we look at tin and nickel as just two examples, where is this coming from? Yes, there are some mines that can perhaps improve a little bit of what they're doing, but not to the extent of what I think the market is going to require over the next 5 to 10 years.
Let's move back and take a look into some more detail about pricing for 2021. You talk about the recovery that China has experienced and its control of the coronavirus and the fact it's able to get back onto a relatively stable footing. Is it easier now this year, do you think, to look out for 2021 and predict where things go? Because as sure as anything, we still don't know whether or not we've got to the end of the pandemic itself. And in Western society, we've got a number of people just not believing that lockdown is the right thing to do. So we still don't know yet whether or not we're going to be locked down for a fourth occasion coming into the meat of 2021. What is the pricing forecasting environment looking like for 2021?
Well, it's a lot more certain this year. We know we've got vaccines being rolled out as fast as everyone can roll them out. Certainly, the UK vaccine rollout program is going at a great pace. The Europeans are doing their best to catch up, even though they haven't approved the Pfizer vaccine yet. So there's a lot of hope now coming into our markets and our expectations. I think I certainly think the demand is going to increase as we come through. There's a lot of new stimulus money coming in. We've seen extraordinary numbers of new projects being approved and now being financed by government agencies, not just in China, but in the UK, in Europe. And I think there's going to be a lot of new stimulus money in the US. Joe Biden's 1.9 trillion to start with. And that, if we add these up, our stimulus tally, which I last saw at about 17 trillion, should go to something over $20 trillion.
Yeah, that's a massively large number. Very difficult to quantify just how many noughts there are in that, but it's a very, very, very large number. But of course, one of the other things that's going to happen, presumably, in this environment where we got higher pricing because of this increased demand and the fact we're just not getting the feed through from the mines in metals, ultimately, we're all going to have to pay more for what it is we're going to buy, whether it's mobile phones, whether it's electric vehicles, whether it's power coming into our homes to charge all these new things that we're buying. That's going to have an uplift in pricing. Now, that's going to produce an environment where we do have inflation potentially returning. What sort of difficulty is this going to mean to an environment where we have all this debt that we've got to pay off?
Well, certainly there's inflation has to come into the equation here, and the gold price has done quite a lot on the back of inflation expectations. But I think as inflation really comes through, gold is likely to continue to appreciate higher. So our advice to anyone looking at buying these metals is right now buy the dips, if there are any dips. I think I'm not sure I'm brave enough to see gold going through $2,000 an ounce this year, but it's certainly heading that way. For copper, I think copper is going to go through $10,000 a ton. I think nickel is likely to go through $20,000 a ton. Tin probably going through $23,000, $24,000 a ton at some point, because these metals are going to be so much in demand, and they're all inflation hedges, not just gold, but all of them. And yes, the new demand for gold will probably increase because I think people will go back into the jewelry stores. I think people will be looking at gold as an inflation hedge, but not just an inflation hedge, but a hedge against volatile currencies. Because as governments print more cash, the value of those currencies becomes a little less certain. So, and we're in a world where I think Bitcoin is going to remain very volatile. So we know central banks don't like Bitcoin. They accuse it of being a currency that's used for a lot of illegal purposes. And so there's going to be big political pressure, I think, to kill Bitcoin off. And gold will probably be an unwilling beneficiary of that.
Yeah, interesting quote from Andrew Bailey from the Bank of England just a couple of days ago, suggesting potentially that Bitcoin itself may not actually last much longer, given the new technologies that are coming on stream. Not suggesting that digital technologies and digital currencies are going to go. It's just a quote on Bitcoin specifically. John, just one final thing that I wanted to catch up on. I know that you have written about this as well in your morning note over the last few days or so, is that Brexit has given the UK an advantage when it comes to electric vehicle batteries. Now, this is a quote I know from Nissan. Nissan has always been one of the flagships of the Remainers as much as anything, because many were saying that if we stayed within Europe, the likelihood is that Nissan would stay in the UK. And if Brexit was to happen, Nissan would be one of those first that was exiting the doors. Doesn't seem to be the case.
I never really thought that Nissan would leave the UK. The bond between the UK and Japan is very strong. All throughout the Brexit negotiations, the Japanese have been incredibly supportive of various British governments that we've had. And of course, the British government now is unshackled and is able to move and react much faster to the global environment and to stimulating the local economy. And we're seeing that with the faster rollout of vaccines that's going on right now. But the challenge is on. The EU has said we can export cars tariff-free into Europe so long as there's enough local content, as in UK and European content. Now, the challenge is there. We have to develop more battery factories, which is happening. There is a battery factory up in Sunderland, very close to the Nissan factory. There are other battery factories that are certainly being planned, because we've got the Jaguar I-Pace and various other vehicles being built in the UK. I think this is going to be an area where we lead technology. We have a close connection with certain European automotive manufacturers who are also looking to develop their own battery factories. And the reason why we're talking to these guys is because they are looking to source high-grade, high-quality raw materials, particularly in graphite and nickel, not to mention the lithium that needs to go in as well for to feed those battery factories. And it's important that everybody gets it right, because you need to be producing good quality batteries, and you can't do that unless you have good quality raw materials going in. And unfortunately, they're going to have to pay up for it, because there's so many battery factories coming into this space, all looking for the same raw materials, all trying to talk to the same companies that are producing this, and somehow they're going to have to fight to ensure that they're the guys getting the supply. So, I mean, we're going to be very pan-European on all this, but at the same time, the EU has said we've got to make sure that we're buying enough locally. So we can't be buying the in the next 4 or 5 years' time, we can't be buying the batteries in from Japan anymore. We've got to be making them locally. And of course, that's great. That's exactly what we want to do.
Interesting developments. Okay, John, thanks so much indeed for joining us. That's John Meyer there from SP Angel with an updated comment for us here in 2021 for the metals market. For more videos from us here at IGTV, join us on Twitter at IGTV and subscribe to our YouTube channel.